Hello and welcome to an FX Times daily fundamental market recap. I'm your market analyst, Nick Nassad. Today is Thursday, December 3rd, 2009. We begin our broadcast by taking a look at the Eurozone, where we had the European Central Bank deciding on interest rates, and they held rates steady at 1% as was expected. However, President Trichet did deliver some signals that the ECB was beginning to head for the exits in regards to its extra liquidity measures that it has taken on since the financial crisis. At the same time, ECB staff projections on inflation and growth for 2010 and 2011 didn't imply a rapid need to increase interest rates. So, some of the steps that the ECB will start taking in order to withdraw some of its extra liquidity measures is that its next long-term refinancing operation, which is to be held on December 16th, will be the last, and the rate will not be fixed at 1%, but instead will be tied to the benchmark interest rate. Also, the ECB has said that it will discontinue 6 months loans to banks after March of next year. And that they will only guarantee unlimited funding in its other refinancing operations until April 13th. So these three measures will take away some of the cheap funding European banks have been getting to deal with the recession, and the response by investors was a bit of a knee-jerk reaction as we had selling in the euro. The euro had rallied overnight, but following the ECB announcement and ECB President Trichet's press conference, we did see the euro give up some of its gains. In that conference, Trichet was asked a question regarding the US dollar, and he said that the ECB has a very important stake in a strong greenback. In addition to some weak data from the services sector in the US, that gave the markets enough risk appetite to cut some of the gains we had seen in the overnight trade. The Eurozone also released a second version of its third quarter GDP figures, which matched the preliminary estimate of 0.4% growth in the economy, so we had a confirmation that the Eurozone economy did emerge from its recession. The release today had some extra data, and we saw that personal consumption declined for the third quarter, as did capital spending. The reason we did have an increase was an increase in exports that added a net 0.2 percentage points to GDP, as exports were higher than imports. We had inventories at 0.3 percentage points, and government spending added 0.1% to the GDP calculations. So what the data shows here is that consumer spending is rather weak in the Eurozone, and with unemployment close to 10%, we may continue to see consumer spending faltering during this recovery. So we're also going to see government withdrawing a lot of their European governments withdrawing a lot of their fiscal stimulus measures, and so we'll see how the recovery shapes up. In a look at retail sales for the month of October from the Eurozone, the release was a disappointing one as sales were flat on the month, and forecasts had called for a slight increase. On the year, sales are down 1.9%. So following the GDP report, which had showed weak consumer spending, we have another bit of data showing that in today's October sales release. Switching to the US, we had two important releases, one being US jobless claims for the week ending November 28th that surprised forecasts on the upside, as claims fell by 5,000 to 457,000, when forecasts had called for it to rise to 480,000. So that was the fifth straight week that claims have declined, and it's the second week that we saw claims below the 500,000 level. However, continuing claims did rise by 28,000 to 5.46 million. And that was lower than the previous month, so obviously this should not be actually gold, but it's a negative to the labor market. However, the overall release is a positive, and as we can see from our chart to the right, we've seen since we peaked jobless claims around the 650,000 level in April, we are seeing a steady decline, and now we're seeing figures that we saw about a year ago in terms of jobless claims. So the labor market shows, it's an encouraging sign, but tomorrow we'll get a much clearer picture as we get the November non-farm payroll report from the US. Contrasting the better-than-expected jobless claims report, we had the ISM non-manufacturing index come out for the U.S., which measures the services sector, and we had a very disappointing result as the sector contracted in November, with the index declining to 48.7. So we could see that following a trend of higher gains here in the index, we went above the 50 level for 2 months in a row, but then now we fall back below the 50 level. While new orders remain close to their level from the previous month, we did have a rather sharp slide in business activity. So that means that respondents were more cautious about business conditions during the month. On the employment side, we saw the employment figure remaining around 41.5, so it actually came in at 41.6, which shows that the services sector continues to shed jobs. So that is different than what we've been seeing from the manufacturing PMI, which has had employment above the 50 level for 2 months now. Overall, a very poor release for the U.S. services sector. With our fundamentals out of the way, let's take a look at some currency pairs and see how the market behaved in today's trading. Here we're looking at the euro-dollar pair, and we see that during the Asian session and during European trading, the euro rallied and managed to move above its highs that we saw in the previous 2 sessions. We reached a high around 1.5140 after the ECB announcement, but as ECB President Trichet's press conference got underway and he made his statements about a strong dollar, we did see a slide in this that was, and we were kept down here as we had the weaker than expected U.S. services PMI. So that came out in this candle here. Stocks in Europe did open higher, and there was some good news in that Bank of America announced that it would repay its $45 billion in TARP funds, and that bout of risk appetite helped the pair to reach this high. However, that came up against resistance level from last week prior to our slide as a result of the Dubai debt situation, and we did see a rejection of that level, and we retraced about 50%, or even a little bit more, of the original overnight rally. The pound-dollar pair slid more sharply than the euro-dollar pair, reversing all of its gains from yesterday and retesting yesterday's low, and this slide started in European trading. If we take a look at the dollar, broke a key level in the dollar-yen pair, rising above the 87.50 area, which had acted as resistance earlier in the week and was support during our slide here at the end of last week. So we managed to puncture that area, and now we came up against this support turn resistance level here. So traders continue to be keeping an eye on the Bank of Japan, which we're seeing if they have any plans on intervention, while Tuesday's extension of a new funding facility by the Bank of Japan, which should help to lower yen interest rates, continue to drag on the Japanese currency. Finally, at a look at the US dollar Canadian dollar pair, we see the greenback gaining in today's trading, mainly in New York morning trading, on some increase in risk aversion following the US services PMI report and weaker oil prices. So that extended gains by the greenback against the Loonie from yesterday, and following our test here on Tuesday of the 1.04 area, we have rallied back to the 1.0580 as our new resistance. Now let's turn our attention to the upcoming fundamental docket. Overnight, Switzerland will post its consumer prices, while tomorrow we get Canadian unemployment change and unemployment rate, and the U.S. non-farm payroll release, the monthly jobs figure from the U.S. Expectations are for a decline in jobs of around 110,000, where last month we had 190,000 jobs lost. Also tomorrow we'll see U.S. factory orders and the Canadian IV PMI. And that will wrap it up for today's broadcast. For more news, analysis, and videos, including today's technical update video recap, please visit our site fxtimes.com. Thank you for watching, and happy trading.